A method is a consistent way of doing things. We have methods for everything in life. How we get ready for the day, how we interact with people, how we conduct business. Each pattern follows a calculation, a decision, a balancing of risk and reward, of investment and return, of the temporary and that which is eternal. Underneath the surface, our methods are really motivated by three things: what we think we want, what we want to avoid, and ultimately what we really desire. Money, madness, and the pursuit of lasting wealth. I'm Matt Hearn, and this is Method to My Money. That and again, welcome. Thank you for being here this evening. My name is Matt Hearn, a certified financial planner with Cannon Wealth Management, and I have Joey Perkins joining me this evening, CPA with Cannon and Company, and we are going to be talking about 10 end-of-year tax tips to trim your taxes. It's a lot of T's, and I know that's exciting. You want to see and hear all about this evening and here at the holidays, but we will jump right into it. Joey, you still with us?
I'm right here, Matt. There was some nice pool sharking you did there. I like that.
That video was a ton of fun, man. I just didn't, we had to shoot the shots numerous times. Let me just put it that way.
You don't have to tell anybody that.
Right. We do. Well, we believe in being transparent here at Cannon Wealth Management. So. But again, thank you for being here. We're going to try to keep this brief, go through these 10 tax tips, end-of-year tax tips quickly, and I think you'll find that this is helpful. Something in this material will be helpful to you this evening, and just want to reiterate the importance of sitting down with your CPA here at the end of the year and doing a tax projection. So first off, just a little bit of background. This is Method to My Money. It's a series put out by Cannon Wealth Management. Past episodes, Retire Without a Pay Cut, Kids in Cash. That was me and Elijah did that one together, and preparing the next generation to make smart financial decisions. Tax Efficient Giving. That was hosted actually live at the Maple Chase Country Club a few weeks ago, and Joey was one of our speakers there. Did a great job talking about tax efficient ways to give, to be charitable. And then tonight, the episode 4, 10 end of year tips to trim your taxes. Future topics will include things like financial simplicity, how to get organized financially, investing in a rapidly changing world, caring for loved ones in sickness and in health, finding peace in your finances, income and expense planning. Where did it all go? Where's the cash going on a monthly basis? Trying to keep up with that and budgeting. Leaving a lasting and loving legacy. And then we have one planned for our small business owners, planning for the next chapter. Once a small business is maybe the owner is retiring and the next generation is taking over. We'll be talking about a lot of topics in coming months. We try to do this monthly on the second Tuesday of the month at 6 p.m. right here live on Zoom and Facebook. And then we, thanks to Kimberly Stone, our marketing director, she's going to post the replay on our website, cannon-wealth.com, on our YouTube channel and Facebook, of course, and other places. So she is in charge of that. Thank you, Kimberly, for doing that for us. So without any further delay, let's dive in tonight. Method to My Money, episode 4, 10 end-of-year tips to trim your taxes. And let me get my screen back up here. All right. There we go. So the first one, Joey, we have here is cancel your RMD. And this is a real one that we've had a lot of conversations with clients about this year. Certainly, this is a big deal for folks that are age 72 and older, or if they had already been 70 and a half or older before the law changed. What is an RMD, Joey? How can it be tax smart to skip your RMD this year?
So 2020 has been an interesting year in a lot of different ways. I don't think we have to tell anybody about that, but the CARES Act was enacted back in March. I don't recall the exact date, but sometime back earlier this year. And one of its provisions was that we could skip an RMD, our required minimum distribution, for this weird and crazy 2020 tax year. What is an RMD? It's like I said, a required minimum distribution. The IRS and Congress allowed us. It was so nice of them, and they allowed us to contribute to plans, an IRA or a 401k throughout our working career. And then when we retire, they want us to take that money back out, and they want to get their fair share, I suppose. But what an RMD is, they're going to require us, based on our life expectancy, to take out a certain amount each year after we turn 72. And for this 2020 year, the CARES Act allowed us to skip that. So the obvious tax smart thing to do, if you're not living off of those RMDs, if you don't need to take those RMDs for monthly or annual expenses, don't take the taxable income. Skip it for 2020. And then, of course, that'll adjust your RMDs for future years. But again, I always am an advocate for, as far as we can defer taxes, let's defer taxes. And then there are some provisions in there where if you have already taken your RMD, I believe it's a 60-day window. If you check with your custodian after you've taken that, and you may be able to recontribute that back into the IRA and negate the taxable income that you generate by taking it.
Yeah, there are some ways to potentially negate that. Certainly reach out to your financial advisor and your CPA, absolutely. And I just noticed that we had some folks join us. Thank you for joining us tonight. Again, this is Method to My Money, episode 4, 10 end of year tips to trim your taxes. I have Joey Perkins, CPA, with us tonight, and he is helping me out. And I really appreciate him being here. Thank you for being here, those who just joined us. And so the first one, cancel your RMD. Let's slide to number 2. Tax tip number 2, 2020 offers a rare opportunity to deduct up to 100% of your AGI. This is also part of the CARES Act. We had folks who want to be charitable this year. And anybody who is charitably inclined, especially right here at the end of the year, or really throughout the year, but especially right here at the end of the year, a lot of folks are charitably inclined. And you may find that you can do a little more this year than possibly in the past, because you see that there's potentially a bigger tax deduction, because you can gift up to 100% of your adjusted gross income in cash. There are some exclusions there. I think donor advised funds and some other things that are excluded from that. But cash gifts, qualifying organizations, you can deduct up to 100% of your AGI. What is AGI, Joey? And maybe talk about any other strategies from a charitable gifting standpoint you can think of.
Sure. AGI is adjusted gross income, and basically what that is, without going into all the gory details, is basically all of our income items, whether it be our W-2s, our interest income, dividend income, capital gain activity. Maybe we have a business or a side gig or something along those lines. Social Security falls into there. That would be our total income, and then that's adjusted, i.e. adjusted gross income. That's adjusted by maybe an IRA contribution, maybe a contribution to an HSA, and there's several others. Student loan interest is one. So there's several things that go into that calculation. And then the AGI is an important number in most tax returns, because a lot of limitations are based off of AGI, such as this one that the CARES Act gave us. Had been 60% before for cash contributions. CARES Act upped that to 100% for contributions made in 2020. So yeah, it's a good time. And even the bunching strategy that's referenced there in the second bullet point is the idea that maybe you take your 2021 giving and accelerate that into 2020 when you have more room to make those contributions, and just early give those 2021. The bunching strategy became is popular. So I'm an advocate for it. It became a little more popular when the standard deduction limits were raised with the Tax Act that came into effect in 2018. Basically, married couple going up to 24,000 from roughly 12. Put a lot of people that would have probably had been itemizing with mortgage interest and their charitable giving, maybe put that out of reach with that 24,000. So the bunching strategy allows us to maybe bunch some charitable giving into 1 year to eclipse that 24,000 or the standard deduction rate for yourself. Another one to mention right here is the donor advised fund. Maybe a little, I won't say aggressive, but maybe, you know, a little bigger commitment or a little bigger move. That would be something maybe you would take the next 5 years worth of giving or whatever and pull that into 2020 because of the 100% limitation that's in place. But pull that giving into a donor advised fund, get the tax deduction currently 2020, and then be able to dole out those contributions over, you know, as you see fit and to whom you see fit. So a lot of good opportunity from the CARES Act for charitable giving and getting a nice tax deduction this year.
Yeah, and really with those donor advised funds, you're not restricted on when those gifts are actually doled out to the charity. I mean, you could put that money in the fund and it could grow for years, and you can make those recommendations to the fund for giving later. So it doesn't mean that the charity gets all the money now, right? It just means that you get the tax deduction now, and then potentially that money could grow if it's in, you know, if the investments do well. So yeah, great idea.
Yeah, probably important to point out too that you know, although the fund may grow, that doesn't generate another tax deduction. It just is
right.
more money headed to the charities. Good for you for being able to give more money.
Yes, absolutely. So, all right, and then number three, running a business from home. So a number of folks out there today are either they've been laid off due to the pandemic or, you know, the recession that it occurred there, and they had to start their own company, or maybe they used to work for themselves, but they worked at an office somewhere and now they're working at home. Maybe some ideas here for our self-employed folks around your home being a place of business. And, you know, just a quick quote here. This is from Brooke Salvini, a CPA, member of the AICPA Executive Committee, the PFP, Personal Financial Planning Executive Committee. I believe that's what that is there. If you have a home business or a side gig, take this time to look at your profit and loss statement so you won't be surprised by lower expenses and higher taxable income and taxes than expected come tax day 2021. Now might be the right time to squeeze any large business expenses you have been considering. So speak to that, Joey, if you don't mind, just the importance of the home, I guess the potential business deduction that you can get, business expense deduction around either the space you're using at your home and or the expenses that are incurred with outfitting a home office.
Sure. You know, probably the important distinction to make here is that, you know, prior to the Tax Act that was effective 2018, miscellaneous itemized deductions included a potential home office expense or home office deduction for employees. At that point, the Tax Act did a lot of good things, gave us a lot of new opportunity, a lot of interesting strategies for small businesses. But the one thing that it did is it took this away for employees. So if you're an employee, you know, sorry, there's not a deduction there. But if you're self-employed or in some manner have a side gig, I believe is what the quote said. But if you have that going on and you have a dedicated spot in your home where you do that business, then this deduction's available to you. It would be taken on the Schedule C or the form where you report your income and expenses for your business or self-employment. And you can see there in item number 1, the usual expenses that we would include there: property taxes, mortgage interest, rent, utilities, insurance, maintenance, repairs. I'll talk about depreciation here as I close it out, but all of those could be included, and they would be recognized as an expense of your home office pro rata for the square footage that you're using. So if you've got a 10 by 10 and your house is 2,100 2,000ths of those expenses would be deductible as a home office. The reason I left depreciation off that, just an important side note, not to go too far off in the weeds here, but if we do take depreciation as part of a home office, right now, most of us, when we sell our homes, and hopefully we'll recognize a gain on that sale, that gain for a married couple up to $500,000 is non-taxable. If we have taken depreciation as a home office deduction or somehow used depreciation, we'll have a little piece of that gain that could generate a tax liability down the road. So because it's often so small, and that's a complicating factor, I generally just tell folks, my clients, to let's not worry with the depreciation. Let's get our other deductions in there and take advantage of those and not create a problem for us down the road. There are 2 methods there, the regular method, simplified, and I spoke to the regular method as far as just taking all of those actual expenditures and then applying the pro rata portion of your home that's being used for the home office. The simplified option basically just applies maybe a $5 rate to the square footage that's being used, and we would look at both of those and determine which one had the better result. Okay. You ask another question, Matt, about expenses for the home.
Yeah. Well, the one question that comes to mind, and I'm not sure if this is the one that you're wanting me to. But the one question that comes to mind is, if I'm a business owner, maybe I've worked away from the home in the past, but this year I'm working at home a lot. And here it is, the end of the year, and I really need a piece of equipment, or I really need, to build out a couple of walls here in order to make sure that my kids don't run in every time I have a Zoom meeting with a client. I've got some privacy there. Is that a good move from a tax standpoint here at the end of the year?
Yes, I tell that was it. I tell folks, and the best example, we have a lot of opportunity there. So if you're going to enhance your home office in some way, again, as long as it is exclusive use for that business purpose, we wouldn't want to put in a corner to put that pool table in or something like that, and then treat that as a home office. But as long as it is.
What if you're using it for a webinar?
It seems like it could be an advertising expense. I don't know. But what I would say is that, yes, I mean, now is a good time to do that, especially if you look at your year and see that your income, maybe you were lucky and your income held true, and because maybe your travel was down and you did a lot of business from your home, maybe your expenses are down, and there may be some additional taxable income. I do put the caveat in there, if you're buying, let's call it things, fixed assets, maybe a computer or something along those lines. I have a lot of clients that come in December. I'm doing a lot of that right now. And they say, I've got a lot of taxable income. Let me go buy something so I can create a deduction. And I say, that's fine, as long as you make sure that there's a business need for that. Because if you go buy, let's say, a $5,000 computer, just to use that as an example, you're out $5,000. If we assume maybe a 30% tax rate, so your tax benefit there was $1,500, where you're still out the $3,500 that you were out of pocket of. So I tell folks, great idea, accelerate it, buy it, let's deduct it this year, but let's make sure that you're making a good decision and you're just not creating a deduction and spending money that you shouldn't be spending. You're better off without the computer than paying the $1,500 in tax if you don't need the computer.
Absolutely. It is tempting, though, to go
sure,
out and get that computer.
Good excuse.
Yeah. Number 4 is involved also for our self-employed folks, or a question pertaining to them more. And this is just, if you own a business and maybe you are a single individual just running your business yourself, or maybe you have a handful of a few employees, just 2 or 3 or 4 employees, certainly you want to look at this. You want to look at this with every size company, right? But a lot of small single operator companies, 2 or 3 people, forget about the value of these retirement plans. And just really quickly want to share, and here are some quick numbers. But if you're a sole proprietor and you made $150,000 and that's your income, your net income after expenses, $150,000, you could actually put in 2020, and this is for someone who is over age 50 or 50 years old or older. There's a little bit extra for those folks, but you could actually put $53,890 away for your retirement and be able to write that against your income. So Joey, you can speak to the value of that. If somebody is earning $150,000, they're not in a low tax bracket. They're not in the highest tax bracket, but they're not in a low tax bracket. And how beneficial can that be? I'll let you think about that. In comparison to the 401k, the SEP IRA, you can only do $27,890 with that same level of income. And the simple IRA, you can only do $20,561. It's still a lot of money, but less than half the amount that you can do in the 401k. So certainly something to think about. A lot of people don't realize that I can do a 401k if I'm an individual. Maybe I'm a real estate agent. Maybe I'm just working out here by myself, working hard, doing whatever. 401k is an option for you.
There's so many options, to a deferral product of some sort, and there's, so much, they're different, and I suppose I have clients that utilize all of these, and then of course you've got the individual retirement account, the IRA, that you see business owners, much less money can go into that, but I still see business owners using that. Some of it depends on cash flow, right? You got to have the cash to throw in there and take that out of play for a while. But what I like about a lot of these is that you don't have to make the contribution in some cases till April. So we can finish up, do the tax return, maybe analyze where they're at cash flow wise, what maybe the next year, 2021, what it's going to look like. Do they need the money right away, or can they put it in some sort of vehicle to defer the tax on that? It's a great planning tool, and it's not as time sensitive. In most instances, it's not as time sensitive as some of these other ideas we're talking about that have to take place inside the tax year. So yes, I think it's always, you can speak to it from a financial planning point of view, but the idea of saving for your retirement is always good. Deferring taxes is almost always good. So yeah, we use these a lot in our tax planning and tax saving strategies.
Yeah. I mean, sometimes you think about, say you're 60 years old and you have the opportunity, maybe you retired from your job that you've worked for 30 years, and you've started your own business, and your business has, generated some income for you. Throw a bunch of money in a 401k, realizing that you can pull it right back out. Let's say you're over age 59 and a half. So you're beyond the point where you have a penalty, and you can put that money in there, get a tax deduction in the year that you need it. And then let's say you fully retire at 62, you could pull that money. You could do a Roth conversion when you're in a lower tax rate. There's a lot of different options there. Certainly want to look at that. I want to sit down with your CPA, right, and just crunch all those numbers. Yeah,
the planning and the not being surprised in March and April. That's what we strive to do all the time. That's why my December is so busy. Is because I spend a lot of time working with my small business owners, individuals that have unique situations, and just doing a projection, spending 30 minutes, an hour with them. Do a projection, and the idea being that I don't want any surprises in March and April. That's not a phone call I like to make. On April the 14th. Oh yeah, by the way, you owe XY, XXX amount. So we try to not be surprised. If there are planning opportunities we can take care of in December, we try to do that, and just have our options open as we approach the filing deadline.
Absolutely. Number 5. So this leads right in Roth IRA conversions. Certainly the tax rates changed back in 2017, or the end of 2017. They changed really in 2018. But Roth IRA conversion remains a good planning strategy or technique for certain people. Not everybody, but for certain people. And this is just something that you want to look at. I mean, especially right now, given the political climate, some of the things going on, people are concerned that tax rates may go up, especially for the high earners. Looking at potential for going ahead and converting some money out of your pre-tax bucket, like your 401k, your IRA, into Roth, so that you pay the taxes now, potentially at a lower rate. We don't know the future, but knowing that the current law is going to sunset in 2026, I believe, and that's already written into the law, so the rates will go back to the Obama years at that point. The rates will just revert back. So something to think about, right, Joey?
Oh yeah, you and I work on this one a lot with your clients and with my clients. So my whole career, practically up until this latest tax act, my whole career, the general rule was always we defer taxable income as long as we can, and we accelerate expense as quickly as we can, with the idea being that down the road, we all heard that when we started contributing to our 401k back when we started, however long ago that was, but that our tax rate was going to be much less when we retire than it is today, so let's pay tax at the lower rate. Well, with the Tax Act of 2017, the rates we're operating under right now, I'm not so sure that's true. I think that we're probably operating under historically low rates. If we did see lower rates, I don't know how much lower we could see rates than we're looking at right now. So we're taking advantage of the low rates with the idea that with the sunset provision in 26, that we feel like it's good money bet on that the rates are going to go higher. In particular, like you said, for higher earners. And that's if you watch the news lately, you hear a lot of talk about that happening quicker. So maybe this particular strategy is important to look at sooner rather than later. Matt, you and I work on a lot of clients, and we're kind of seeing folks trying to maybe cap out that 24% bracket. That next jump goes to 32, and that's a pretty big jump. But 24% on the federal side is that's a nice rate. It may be the lowest you'd ever get to convert that money out of your qualified plan into a Roth. So yeah, that's a great opportunity to do that. You just kind of have to get your mind around that I'm choosing to pay tax today that I otherwise would have paid potentially years down the road. That's probably the biggest hurdle for folks to get over.
Absolutely, and if I'm in a lower rate now or lower bracket now than even I think my kids might be in. I mean, think about a Roth. Once you have the money in that Roth, and that's great money to leave to family because it just passes on to the next generation. Yes, they have to take money out of it over there, the next generation does, but they don't have to pay taxes, and they might be at that point in a much higher rate if you think 20, 30 years down the road, just depending on the direction this country goes with taxes. So yeah, something to think about.
Very powerful, for sure.
The number 6 here, we don't want to leave out HSAs. HSAs are probably one of my favorite tools for tax planning. I call this a triple tax-free opportunity. What is an HSA, right? HSA is a health savings account, and think of it as like an IRA almost, because you put money in and you get a tax deduction. Now, let me say right off hand, you have to have a qualifying high deductible health insurance plan to use an HSA. But call up your HR department, call up your insurance company, ask them if you have a high deductible plan, a qualified high deductible plan. If you do, then you can use an HSA, which means you can put money in there, receive a tax deduction on the contribution, and then when money comes out of that, well, first of all, as it grows, if it's invested, or let's say it's in an interest-bearing account, as it grows, it's tax deferred. So that's your second advantage. And then number three, withdrawals come back out tax-free for health expenses. And there's quite a few health expenses that you can use or that qualify for this. We just wrote down some that were a little bit out of the ordinary that you might not think about. COBRA health insurance premiums. I mean, a lot of folks, maybe you have a job now, but you're worried that you might lose it someday. Have this HSA building up because your COBRA health insurance premiums can be paid. Long-term care insurance premiums down the road. You know, if you get the place in your life where you really want to have long-term care insurance, the health savings account money can be used for that tax-free. Vision care, eye exams, eyeglasses, even laser eye surgery or LASIK surgery. Orthodontist treatment, you know, orthodontia, prescription medications, taxes on medical services and supplies. So there's quite a comprehensive list of qualifying health related expenses that you can use HSA money for. And one of the, I think, you know, advantages I see is even if you are perfectly healthy and you put your money in this thing and it grows and you got a deduction when you put it in and it grows, once you get past age 65, you can pull that money back out, use it to buy whatever. You're going to pay ordinary income tax, but at that point, after age 65, there's no penalty, right, Joey? Am I correct about that?
You are. It's you know, again, another powerful tool, maybe underutilized in a lot of cases. I'm seeing it more and more, but still probably there are more folks that could use this. And I think that a lot of times from a planning point of view, I think about, you know, you don't want to put too much of your money in a vehicle where your access is limited. And this, you know, the idea that you just mentioned, the fact we can use it up to age 65 for health expenses, tax-free, a current tax deduction when you make the contribution, and then tax-free when you take it out, even with the growth. And then at 65, it becomes, you know, sort of an IRA, or it acts like an IRA, in that you can take it out for any reason. Tax consequences, sure, but it's not like it's tied up and out of reach for you know, through your estate or whatever. You still have access to it for even non-health related expenditures in retirement.
Mm-hmm. And so that's number 6. Number 7, go ahead and look at your, you know, this is important for the end of the year here. Go ahead and look at your losses. This year, folks might have some losses, right, Joey?
You tell me, man.
Some capital losses, losses on paper. Hopefully well, I'll say this, for our investors, we encouraged them to ride through this pandemic, and we were able to take some capital losses in many portfolios back earlier in the year, and then move that money into something that will hopefully, at that point, we were, you know, based on our research, looked like things that would rebound quickly. And sure enough, investor portfolios have rebounded for the most part and are doing well. But with that being said, you know, generated those capital losses along the way. And in some portfolios, we have a lot of capital losses. Could be an opportunity to go ahead and take some gains. So, and those gains are not be taxable because if you've got a short-term loss, you can write short-term gains against that. If you've got a long-term loss, you can write long-term gains against that. And I wrote this down because it's a little bit complicated, and I know, Joey, you can explain it better than I can. But the way the rules are with with tax loss harvesting is you do have to be sure that you look first at short-term versus short-term, long-term versus long-term. And then if you have a long-term loss and you don't have any long-term gains to offset that, that's when you can go and look at your short-term gains, and you can offset your short-term gains against long-term losses. Just call us. It's a calculation that needs to be made there, but certainly call your CPA, reach out to Joey if you don't have one, and let them run some numbers for you. And then obviously watch out for the wash sale rule. You may have heard of the wash sale rule. Careful not to sell an asset to generate a loss for tax reasons and then buy that same investment back within 30 days. You want to wait till that 31st day to buy that investment back if you want to own it. So, Joey, anything you would like to add to this?
You did a good job there explaining something that's a little complicated with the short term versus long term. I think the overall, we do this a lot. There's a lot of folks that have portfolios that have some appreciated stock wrapped up in there, and we're always looking a couple ways to diversify out of that, or maybe to take those gains out of play for folks is and limit the tax side of it. Number one, obviously, this goes back to the charitable idea. We can give appreciated stock to a charitable organization. That's one way maybe to help out with the tax bite there. But just to go through the portfolio, good exercise for your financial advisor to go through there and look for losses that maybe could be those dollars could work for you differently if we went ahead and took the loss and invested them in a different manner. And then you've got down there that we can go $3,000. I call it kind of going in the hole beyond our gain activity, if we generate losses in excess of our gains.
Absolutely. It's something to keep in mind, as you plan for the future too, because sometimes these dips in the market can be opportunities to go ahead and swap out of some things that maybe you didn't want to own, but you were owning them because you were worried about the tax bite. But you see these dips in the market, you can sell and then get into what you really want to own as well. That's another thing just to be thinking about. I'm not saying that that's coming. I don't have a crystal ball, but we do see these dips in the market from time to time. So number 8, gift now to potentially reduce estate tax later. This is just something that I've been reading a lot more about, even in the last couple of months, just from estate planning attorneys and also from accountants. The idea of, hey, we've got 11.58 million per person right now, which, I remember when it was less than $1 million, the estate tax exclusion, and so it's just inched its way up over the years. I mean, a married couple, what is that? It's almost over $23 million, I believe, that they as an estate tax exclusion. So what that means is, if you pass away and you have, as a married couple, $23 million approximately, before you actually get into worrying about estate taxes, the way the law is today. But if the law changes, right, which we think there's been a lot of talk around this, one of the easiest ways, or the easiest ways to generate tax revenue if you're the government is to tax after people have passed away, right? Those folks can't vote. So something to think about, right? So if you go ahead and get with your estate planning attorney, get with your accountant, and go ahead and do some creative planning now to grandfather in, and the IRS has, obviously don't know what they're going to do in the future, but in the past, they've allowed that grandfathering. If you set up a trust and you move that money now, then you've taken advantage of that gift exclusion. The gift exclusion is also 11.58 million, right? So, and I think it's going to 11.7 next year, but it's possible they might change it next year, right? So think, Joey, any thoughts on that? I mean,
couple maybe, yeah. If you read the proposals of what the new tax law may be, this is a big area for for that. They're talking, or the proposals reference maybe going back to 2009 levels, which would be more, instead of the 11.5 number, more like a $3.94 million number. So better than cutting that in half. The first thing to determine if that if that affects you, that's, number one is does that affect me? And then I think it's always important to periodically get with your advisors, whether it be the financial advisor, possibly the CPA, or certainly maybe your estate attorney or whoever's done some estate planning for you, and just maybe take a look and make sure that your plan is still okay. I think we'll get some clarity on that. I may need to restate that, but I think there'll be conversations about that in the coming months, and maybe we'll get some clarity on the direction of what those limits may move to. But I would imagine that based on what's going on, if a new administration comes on, I would imagine that 11 number is going to move.
Right. Yeah.
Just that's a pretty big target for the new folks, and I think we'll see that. So not a bad time to maybe update your plan, make sure your strategy still will work or accomplish what you would like for it to accomplish, maybe in a new tax environment.
Absolutely. And keeping in mind that you can gift $15,000 per person, as a couple, $30,000, and you can do that for each grandchild, so there's a lot that you can do even without getting into the gift tax issue or estate tax issue. You can do that annually. So granted, don't give away money that you need, but if you have disposable money that you're planning on leaving the family anyway, something to think about. And then number 9, and we'll try to move quickly here, but take the opportunity to rebalance and shift to a more tax efficient investment strategy. If you've got a bunch of losses right now built up, capital losses that you can use this opportunity to go ahead and move into a more tax efficient strategy. And this is something not really related to the end of the year. This is something that we would just encourage people to do anyway. If you're holding investments in a taxable account that are taxed at higher rates, think about that. Think about how that's probably not the way you want it to be done. If you have high turnover mutual funds, or maybe taxable bond funds or taxable bonds inside accounts that are non-qualified. In other words, they're not IRAs, they're not Roth IRAs, they're not tax sheltered. That can be probably an unwise choice if you have the ability to shuffle that investment. Buy your more tax inefficient investments inside of a qualified account, inside of a tax sheltered account, and then have your more tax we call it tax aware or less or more tax efficient investment strategies should be in your non-qualified accounts. I'm using terms that folks may not be familiar with, Joey, but I essentially you just want to, we call this asset placement. So make sure you're placing the right types of investments in the right types of accounts so that you are not paying more in taxes than you should.
I think that's all. I get to the coordination maybe between the CPA and the financial advisor, just to make sure that what I see it I don't see it as much in December, because those are the folks that we're working with and planning and doing the appropriate things. What I see is, I have a client come in March for a tax appointment, and they've maybe made a move with possibly maybe taking a capital gain or whatever, or maybe, switching out of one investment type into another, and maybe it wasn't the best move for them tax wise. And had we had a little communication on the front end between tax guy and investment guy or gal, that we maybe could have had a little better outcome. So what I would encourage folks to do is just, be aware and try to maybe, be a little proactive prior to year end, and make sure you make the moves that get you where you want to be. Whether tax is important, whether earnings are important, capital growth, whatever your goal is, just make sure that you plan appropriately. Well said.
And then number 10, don't miss on retirement income tax deferral and employer matching opportunities. Right here at the end of the year, it's a good time to go and look at your check stub and see if you have put enough money into your retirement plan to get the full match that your employer is potentially matching on those contributions. So if they're matching 3%, 4%, 6%, whatever that number is, make sure you've put in enough to get that full match. And if you can put more in right here at the end of the year, reach out to your HR folks, see if they'll let you do that in order to make sure you're not leaving money on the table. That's just a year-end strategy we always encourage people to do. And then also there's an added benefit of that being pre-tax dollars that you're putting in. So not only are you getting that match, but you're reducing your taxable income for 2020.
Easiest money out there, right, Matt?
It's an immediate double on your money when they're
That's right.
when they're matching you. So don't leave that on the table. Very important.
Yep.
So that wraps it up tonight for 10 end-of-year tax tips, 10 end-of-year tax trimming tips, hopefully for you. Hopefully you found that helpful. We are going to be doing this every month on the second Tuesday of the month. And next time, well, I won't read through the list, but we've got quite a few exciting topics coming up. I think they're exciting. These things are ways to improve your financial situation. Thank you, Joey, for being here tonight. I really appreciate it. When we start talking taxes, I appreciate your help so much.
Thank you for the opportunity, Matt. I'm happy to do it. I would just leave everybody and say that, plan. That's probably the number one takeaway that I would give folks is just to, plan, be proactive, be ahead of the ball, and at least, even if there's a bad outcome, if we have a lot of income, maybe we're going to owe a lot of tax. That's an issue some folks have. That's not a bad issue, but at least we know, and we're not surprised by it.
Absolutely. Absolutely. Well, thank you for your time this evening, and thank you for joining us. We're out of time for questions and answers live, but if you'll send those in to us at either mhearn@cannon-wealth.com or jperkins@cannon-wealth.com. If you'll send them to me, I'll forward them to Joey. That way I can make sure he gets them. But we will certainly answer those for you, and we want to be a help. Tip number 11, give your CPA a call as soon as possible. If you haven't done end-of-year tax planning yet, that you need to at least make that phone call. Put that on your on Santa's list for something to do between now and the end of the year here. And again, thank you for your time. And I'm going to show you a quick concluding video here.
I'm Matt Hearn, and this is Method to My Money.